The earnings season has begun on a subdued note. However, there are a few companies which have bucked the broad weak trend. Let's do a three-point analysis to really find out which are the stocks which could be the offbeat picks on the back of earnings season. 1. Plasti Blends India. Well, it is the largest domestic manufacturer of color and additive master badges. Now, it posted a strong set of numbers on the margins front. Company also belongs to the Coalsite Group. In the quarter gone by, the turnover growth was broadly flat, but due to the lower raw material costs, gross margins expanded by 400 basis points year on year. Further, on account of the lower other expenses, EBITDA margins also expanded to 14.5%, and this is the company's strongest show on the margin front in the last 7 quarters and ahead of the management's expectation of 11 to 12% for the full year as well. Now, note that the lower other expenses is also attributed to the change in accounting standards as well. Now, at the bottom line, the company benefited from the lower taxation and interest cost was partially offset by higher depreciation cost. Now, coming to balance sheet, the company is witnessing lower levels of debt. Promoters have also been increasing their stake in the company over the last few quarters, and the stock has positively reacted after the results and is now trading at a reasonable 12.6 times FY20 estimated earnings. Now, investors can keep the stock under watch for improving operational performance from here on. 2. GTPL Hathway. Well, digital cable TV and broadband service provider has a strong presence in Gujarat and West Bengal, and it has posted a healthy top-line growth mainly on the account of engineering, procurement and construction contract, which has added 237 crores to the Q3 top line. Now, company's paying subscribers have increased on a sequential basis. Broadband revenue has increased by 17% year on year, mainly led by the increase in active subscribers. Now, ARPU or average revenue per user is stagnant at the levels of 415 rupees for the last 4 quarters. Now, debt to equity ratio is at a reasonable 0.26 times. Stock is also trading at an interesting level of 7.2 times FY20 estimated earnings. Now, investors can follow this stock closely for its improving subscription revenue business. 3. Imami Paper Mills. Well, here we would like to qualify the results by observing 2 observations. Company has made a departure from the accounting standard 21 by not recognizing the notional forex loss of 12 crore rupees. Now, company also mentions that this is justified as it presents a true and fair view of the financial performance and also of cash flows. Now, it mentions that it enjoys natural hedge with respect to the foreign exchange losses, since the domestic sales price of newsprint is directly linked with the dollar price of the imported newsprint. Nevertheless, if we do account for the forex losses, reported EBITDA margin slips to 13.7%, slightly ahead of Q3 FY19 numbers. Secondly, the company's debt also remains quite elevated at 1190 crore rupees as of September 19, though the debt is definitely lower than the March 19 levels. Now, debt to equity is at an unsustainable level of 4.8 times. Note that due to the limited financial flexibility, the company was forced to withdraw the planned greenfield project of 2 lakh tons board plant and also faced credit rating downgrade in 2019. Now, even after the recent surge in the stock prices, the stock is more than 50% lower than August 18 levels. However, given the weak balance sheet, the key monitorable for the company remains the steps taken to reduce the leverage both at company at the Imami Group level as well. As of now, investors can really avoid this counter due to the elevated leverage.